Hi, this is John Comarianos with Mindful Advisory. I called my firm Mindful Advisory because I wanted to help investors with the behavioral problems of investing as much as with the mathematical problems of the enterprise. And the behavioral problems can be frequently more difficult to deal with. I think right now investors are suffering from some behavioral problems regarding the 3-month Treasury and money market funds. Basically, there's a desire for instant gratification to get the abundant yield that those instruments are offering. So you can own a money market fund now and get above 5%. You can own a 3-month Treasury, US Treasury, get 5.4%. That's an incredibly enticing yield, given that for almost the entire period from the end of the financial crisis up until about 2 years ago, the 3-month US Treasury was yielding 0.25% or less. Only for a brief period in 2018 and 19, when Fed Chairman Jerome Powell decided he would like to raise interest rates, did it yield more? And then, of course, markets rebelled or kind of threw a tantrum, and Powell proceeded to lower rates. This time, with inflation, he hasn't been able to keep rates low. This is called the T-bill and chill trade. Just own a 3-month T-bill, collect your 5.4%, very attractive. However, this desire for instant gratification may come back to burn investors because it's possible, maybe even likely, that we're going to get a recession next year. It's impossible to predict that or forecast that with 100% certainty, but we may. And if we do, Powell will lower rates and you won't be getting 5.4% on a 3-month Treasury bill anymore. And that's why it might be advantageous to invest in something like a 2-year Treasury now, which, although it's paying less right now at 4.85%, that's as of November 16th, over the 2-year period, you stand a very good chance of pocketing that 4.85% on an annualized basis. Whereas with the 3-month Treasury, you'll get 5.4% on an annualized basis for the next 3 months, but there's no telling what you're going to get when you have to renew or reinvest the money 3, 6, 9 months from now. Remember, by definition, a 3-month Treasury matures in 3 months, and you have to take the proceeds and reinvest them, and most likely at a different rate. The rate may hold up, but it may not. Now, I recently wrote an article about this topic, specifically about the Los Angeles bond firm DoubleLine, founded and run by Jeffrey Gundlach. And Gundlach has been arguing that we're going to get a recession next year. Of course, he can't be 100% certain either, but he's got some good evidence on his side. Namely, the Treasury yield curve has been inverted for around a year, maybe over a year now. What does Treasury yield curve inversion mean? It means that sometimes the bond market gets weird, and shorter maturity bonds, like the 2-year bond, yield more than longer maturity bonds, like the 10-year bond. And that's really odd. If you're going to lend your money to the US government, or really any borrower, if you're going to lend it for a longer period of time, you should get paid more. And every once in a while, that doesn't happen. The bond market goes a little haywire. The interesting thing about it is that every time that's happened since 1950, a recession has occurred within the next 13, 14 months, something like that. Also, before the recession occurs, the inverted yield curve begins to de-invert or become flat, or maybe even upwardly sloping. And in other words, the long-term debt instruments start yielding at least as much as the short-term instruments. And so the curve, as we say, rectifies itself. That's also happening now. And so there is a decent chance we'll get a recession. If you're over-saving, if you've stuffed your emergency fund with more savings than you need, and you love the yield, the 5.4% yield, or the above 5% yield you're getting on your money market fund right now, consider taking the 4.85% from the 2-year instrument on at least part of your money, on the excess savings. It's not to say you should move all of your money market savings out into a 2-year instrument. But if you're over saving and you're just stuffing that money market fund with everything you've got because you love the yield, consider spreading it out a little bit and having some money in something like a 2-year Treasury instrument. Every major fund company offers a 2-year Treasury ETF. Sometimes it's called a 1 to 3-year Treasury ETF, but you can find them easily. They're available easily. So don't be a victim of the desire for instant gratification and getting the absolute maximum yield you can achieve today. It may not be there tomorrow, and it may pay to lock up some of your money in a 2-year instrument. Anyway, this is John Kamarianos for Mindful Advisory. Thank you for tuning in.